Welcome to This Explainer. I'm your Biofuels and SAF trading desk consultant from Durga Analytics. I've spent my career running compliance books against statutory blending mandates, managing speculative credit books against a market view, and designing the actual ETRM systems that hold physical fuel and compliance positions together. So today, we're unpacking Chapter 1, Why Biofuels Are Mandate Markets, Not Free Markets. Whether you're an aspiring trader, a compliance manager, or a risk professional, our fundamental goal today is to totally shift how you view market demand.
We've got a really packed agenda today. We'll quickly cover the program context, the mandate market mindset, obligated versus credit-only desks, the 3% shock, evidence and invalidation risks, and finally, the 5 essential desk gates. Let's dive right in.
Okay, Section 1, the Master Program Context.
Now, context is absolutely everything when you're building a robust trading operation. As a quick reminder, this master program is a sequence journey across 8 modules and 110 core chapters, taking you from what a desk is actually accountable for, all the way through to ETRM systems and leadership behavior. Right now, we are officially in Module 1, Chapter 1. Just keep in mind that the foundational primer annex, that's chapters 0.1 through 0.14, sits right before this chapter and is not counted in those 110 core chapters. All right, now that we're oriented, let's build this foundation.
Section 2, the Mandate Market Mindset.
This right here is where traditional free market intuition will literally lead a desk into serious trouble. I always tell the traders, analysts, and operators I train this one golden rule. A mandatory position cannot be hidden inside a good profit and loss statement. Think about it. If your daily dashboard shows a trading P&L of positive $5 million, but you still have a hard compliance shortfall of 1.5 million units, your desk isn't automatically successful. You still have a massively unresolved obligation hanging over your head.
Let's compare this. In an ordinary market, if a buyer wants a product at $100 and the price suddenly spikes to $150, they can just say, no thanks. The demand falls, right? Discretionary demand. But an obligated party facing a regulatory shortfall, they cannot simply walk away just because the price got inconvenient. The legal requirement is still there. You must eventually reach a terminal compliance state of 0. Now, the route you take to get there, maybe making physical fuel, buying credits, or pulling from eligible inventory, that's optional. But the endpoint is absolutely mandatory.
Moving to Section 3, Obligated versus Credit-Only Desks. This brings us to a super fascinating dynamic on the trading floor. 2 actors sitting on the exact same desk, looking at the exact same market event, and making entirely opposite yet completely correct decisions. It all comes down to their objective function. A credit-only speculative trader holds a position based purely on a price view. Their priority is risk-adjusted return. If the market turns against them, they just liquidate and step away. But the obligated blending desk, they hold a position because a mandate runs directly against their physical fuel. Their priority is valid execution capacity to complete that compliance shortfall. So if the credit price spikes, the speculative trader might sell to take profits. But the obligated trader, they might be forced to buy immediately before liquidity completely vanishes. It's the exact same market, pushing the 2 desks in totally opposite directions.
Section 4, the 3% shock.
Let's see how this builds into real-world exposure by running some actual desk math. Using our canonical program reference numbers, imagine you have a 50 million unit obligation. Now we have to treat regulatory change as an exposure that sets the price, not just some theoretical scenario overlay. A seemingly tiny 3% policy shock, say an upward revision by regulators, doesn't just tweak a spreadsheet probability, it instantly creates a very real, very terrifying 1.5 million unit scramble for mandatory compliance.
So how do we solve that shock? If we model this out using our canonical D4 price of $1.20 per RIN, a purely theoretical all-buy route would cost you $1.8 million in cash. Yikes. But what if your physical system can actually generate compliance?
If we leverage a hybrid strategy, making 600,000 units physically at a canonical cost of roughly 80 cents each, and then buying the remaining 900,000 on the market, your total cost drops down to about $1.56 million. This visually proves the massive monetary value of having physical compliance optionality. You just saved nearly $250,000 by having physical capacity.
Section 5. Evidence and invalidation risks. But hey, what happens when the fuel you blended doesn't actually count? Let's look really closely at capacity here. Your plant manager might excitedly tell you that you have 600,000 rands of physical capacity. Awesome, right? Well, the compliance desk needs to know your actual compliance capacity. If your documentary evidence, like your supply chain mapping or carbon intensity certificates, only supports 97% of that fuel, your hard compliance capacity is just 582,000 units. That missing 3% doesn't just magically vanish. It immediately increases your external purchase requirement on the open market. And this leads us to what is honestly one of the most terrifying concepts in renewable fuels, retroactive invalidation. You have to treat this validity exposure as a first-order risk on your desk. A credit can be generated, sold, financially settled, and literally surrendered for compliance. But if the regulator later finds fraud or an evidence failure upstream, that credit is voided long after the fact. The money you paid, it's gone. But worse, the actual legal obligation returns to your book like a zombie, and you don't get to fix it at your historical purchase price. No way. You have to cover it at today's stressed replacement price, eating up even more of your treasury's liquidity.
Because of these massive risks, we absolutely must treat the compliance deadline as a gate with a rigid status, rather than just a cost you can trade off. As we approach that deadline, it acts as an unforgiving economic cliff. Early in the year, you've got time elasticity. You can swap feedstocks, tweak blending, or just wait for better market prices. But as that clock ticks down, all that cheap physical optionality just vanishes. Suddenly, the regulatory market holds all the leverage, and your demand becomes entirely inelastic.
Finally, Section 6. 5 essential desk gates.
So, considering the harsh realities of invalidation and time decay, how do we actually build an ETRM system and a governance process to survive this? To stop your desk from simply trading a wild forecast, you have to implement these 5 survival gates. When a signal comes in, like a sudden price move or policy drop, you don't just jump straight to execution. First, you define the scope. What exact regulatory instrument and vintage are we talking about here? Next, confirm the evidence. Is the regulatory lineage actually clear and supportable? Then you calculate the executable economics, totally factoring in liquidity depth, not just the screen mark. And finally, you secure authority. Who actually has the power to release or stop this trade? Let me tell you, jumping from signal straight to execution without governance is exactly how desks blow up.
Your primary artifact to manage this entire workflow is the mandate decision sheet. This is a real desk-ready ETRM control that forces discipline. Before any material trade happens, you must define your hard coverage, the exact days remaining to your deadline, your evidence state, and your liquidity fallbacks. You aren't just sitting there saying, credits look a bit expensive today. No, you are executing a strictly governed completion plan based entirely on hard data. And that brings us to the ultimate defining question you have to ask yourself every single time you sit at the desk. Are you trading a simple price forecast, or are you managing a mandatory terminal condition? That distinction right there is the bedrock foundation for every single chapter that follows in Module 1. We've established exactly why this market acts the way it does. Next time in Chapter 2, we'll tackle biofuels versus SAF, where the money actually is, to see exactly how this compliance margin stacks up against the commodity and SAF premium. Thank you so much for joining me on this explainer, and I can't wait to see you in the next chapter.
Welcome back to our explainer of Chapter 2 in the Durga Analytics Biofuels and SAF Trading Desk Master Program. Today, we're tackling a massive, fundamental commercial question, which is, Where exactly does the money sit on an active trading desk? Whether you're a compliance manager staring down a statutory blending mandate, a speculative trader playing credit prices, or even an ETRM system designer, knowing where the true economic value actually hides is absolutely the foundation of your craft. Just as a quick refresher on where we are in our journey, this program spans 8 modules and 110 core chapters. Now, we've just wrapped up the foundational primer annex. That's chapters 0.1 through 0.14, which sit outside the main count. So let's cross the threshold right into Module 1, Chapter 2, Biofuels versus SAF, and where the money actually is. Here is our roadmap for today's desk-ready masterclass. We are going to start by debunking false price headlines, walk through the valuation waterfall, split the fundamental divide between different trading desks, and then finish up with critical ETRM controls and the terrifying risk of retroactive invalidation. All right, Section 1. Let's address a foundational commercial question. When a desk claims there is money in SAF, what does that actually mean? You will constantly hear people casually drop a line like, SAF is expensive, or they'll quote a price, saying it's $6 a gallon. On a trading floor, that is a practically useless statement. Is it expensive relative to conventional jet fuel, production costs, a mandate buyout? Saying $6 a gallon literally tells us nothing if we don't know who legally owns the environmental attributes bundled inside that price tag. Revenue, regulatory value, economic margin, and observable price are simply not the same thing. And this perfectly illustrates why sustainable aviation fuel is so much harder to value than road biofuels. Think of road biofuels like a Lego set, highly decomposable. You can see the distinct, observable pieces like the physical premium and the explicit value of a D4 RIN. SAF, on the other hand, is more like a baked cake. It relies heavily on bilateral private contracts with bundled environmental attributes. The premium depends entirely on what's been baked into that specific private deal. Which brings us to Section 2, the valuation waterfall. Let's look at a standard 1 million gallon SAF transaction and actually deconstruct those true economic layers. So here's the SAF valuation waterfall in action. You start with your conventional jet reference at $2.40 a gallon. You slap on a gross physical premium of $3.60, and suddenly you're staring at a gross purchase price of $6. But wait, we have to strip away the environmental attributes the buyer actually receives. If those modeled attributes are worth $1.20 per gallon, we subtract that. And that leaves us with a true normalized net premium of $2.40. Now let's scale this up to a standard 1 million gallon parcel. Your Treasury Department is going to sweat over this $6 million gross cash outlay. And why is that? Well, because if your firm has a $25 million liquidity limit, this single transaction just ate 24% of your headroom. Gross premium is what drives your cash invoice, and it absolutely bleeds your working capital. But you walk over to the trading desk, and they look at this exact same transaction and only see a $2.4 million net premium. Once they account for the transferred environmental value, that is their actual incremental economic burden compared to conventional jet fuel. And this proves a really critical point. A gross cash invoice does not reflect the true economic reality of the trade. So who's right? They both are, completely right in their own worlds. But if trading marches into Treasury and says they only need $2.4 million to execute this trade, you have a disaster waiting to happen. The valuation model is being dangerously misused there. Cash netting and economic netting are absolutely not the same thing. Moving into Section 3, obligated versus speculative desks. This is our primary desk inversion, where we pit the obligated blending desk against the credit-only speculative desk to see how they behave completely differently. The foundational difference boils down to this. An obligated party must hold a position. A statutory mandate runs against their physical fuel, meaning they face an immovable regulatory gate. It's a hard deadline. The The credit-only trader, however, is just taking a speculative, elective position based on where they think credit prices will go. They're trading strictly on expected return. So let's make this real and inject a little pain into our model. Suppose we apply a combined adverse stress test. Let's say a $400,000 hit on physical premium uncertainty plus a $250,000 hit on environmental attributes. That is a total adverse shift of $650,000. Watch how this completely scrambles the decision matrix for our two desks. Faced with this massive market shift, the credit-only trader looks at the terrible expected return and simply decides to preserve their exit optionality. They step back, they stay flat. The right to not trade is incredibly valuable to them. But the obligated trader, they simply don't have that luxury. Their right to wait is limited by a ticking compliance clock. They must push forward to protect a valid completion, even at a terrible price, because missing a mandate is not an option. The exact same market event forces entirely opposite but entirely rational decisions.
All right, Section 4, Precision and Evidence. This brings us to the first-order risk that dictates everything we do in energy trading and risk management, our ETRM systems, and our compliance controls.
An analyst might proudly march in and publish a SAF fair value of exactly $5.8736 per gallon, but numerical precision is absolutely not the same thing as market observability. A highly precise model built out to 4 decimal places is a dangerous illusion if it's based on a stale, non-comparable, bilateral quote from a different airport with totally different attribute ownership. And here is the failure chain that literally gives risk managers night sweats. Retroactive invalidation. A favorable mark assumes the compliance scope is valid, so the desk commits volume. But then the evidence fails. Maybe a sustainability certificate just wasn't applicable. Suddenly, a compliance credit that was generated, settled, and even surrendered is voided months after the fact. When that happens, your original regulatory obligation returns in full like a ghost. You don't just lose the money, you are legally non-compliant all over again. To prevent this absolute catastrophe, your ETRM data model must demand lot-level evidence. A conventional system that just tracks price and quantity is utterly useless here. Your system must track the physical lot, the specific scheme instrument, evidence aging, and a strict mark hierarchy before a trade is ever approved. We must demand identity completeness and rock-solid attribute ownership. Because the golden rule of this chapter is simple. Every value needs an owner and a legal basis. If your model bakes a policy benefit into the physical price, and then also tries to externalize it as a separate attribute, well, congratulations, you're double counting. If you can't pinpoint exactly who legally owns the environmental attribute, you cannot count it in your P&L. It's exactly like buying a locked mystery box without checking if you legally own what's inside. So we've broken down the waterfall. We know where the money is, and we know how fragile that value is without rigorous evidence. Which leaves us with a final, rather provocative question. Once that value is actually confirmed, which desk legally owns the physical paper and credit exposure? That question perfectly sets up our transition into Chapter 3, where we're going to dive into physical, paper, and credit desks to see exactly how these components map across the trading floor. Until then, keep your mark hierarchies strict and your evidence verified. Welcome to today's explainer for Chapter 3 of the Biofuels and SAF Trading Desk Master Program. I'm your host, a Biofuels and SAF Trading Desk consultant from Durga Analytics. You know, I've spent my entire career in the trenches of this exact market, running compliance books against statutory blending mandates, running speculative credit books against a market view, and sitting on both sides of the RIN, LCFS, and red markets. I've managed bilateral physical trades and literally designed the ETRM systems that hold our physical fuel, our compliance credits, and our provenance positions. So today, we're going to unpack something absolutely crucial. Why separating your trading books isn't just an accounting trick, it is an absolute matter of operational survival. But first, just a quick reminder of where we are in the master program. This is a sequenced journey across 8 core modules and 110 chapters. Now that count starts right after our uncounted Module 0 primer annex, that's chapters 0.1 through 0.14. Today, we're sitting right here in Module 1, Chapter 3, moving beyond the basics of what a biofuel actually is and diving deep into how a trading desk is held accountable for the specific exposures it creates. All right, here's our roadmap for this explainer. 1. The course in the trap. 2. Anatomy of 3 desk books. 3. The double counting danger. 4. Obligated blenders versus credit traders. 5. Hedging cannot fix compliance. And 6. The 3-book exposure map. Okay, let's jump right into Section 1, the course, and the trap. A lot of novice operators make the mistake of thinking they just hold a simple long biofuels position. But as we're going to see, one single commercial decision actually splinters into some extremely complex exposures. Moving on to Section 2, Anatomy of 3 desk books. If we really want to understand exactly who owns which risk on a desk, we have to split things up. We literally have to divide the trading desk into 3 distinct, non-fungible books. First up is the physical book. I want you to picture the actual barges, the pipes, the steel tanks. This book cares about the real physical material, the physical premium, and the very real-world logistics of conversion. It owns the title, the storage, and the yield loss, all before any regulatory value is even considered. This right here is the absolute foundation of the obligated desk. They're dealing with make-or-buy economics and actual gallons of renewable fuel displacing conventional fuel. Next, we have the paper book. These are your screens, your swaps, your futures. It holds the financial instruments that you use to hedge your price risk. But you have to remember, and I stress this to traders all the time, a paper hedge cannot magically fill a physical tank, and it certainly won't satisfy a chain of custody audit. It exists purely to manage financial commodity price exposure. It's just locking in a forward margin. And finally, the credit book. This book owns the regulatory assets, like an RFS-D4 RIN. Now, these assets have a strict, highly regulated life cycle that is completely detached from underlying commodity prices. Think about it like this. A RIN is a regulatory instrument, right? A diesel swap is a derivative, and the actual physical fuel is what's sloshing around in the barge. If you collapse these 3 books together into one messy view, you are fundamentally misrepresenting the core mechanics of your business. So that brings us to Section 3. The double counting danger. Let's look at a classic governance failure and see how easily a firm's reporting can accidentally invent millions of dollars out of thin air if internal transfer pricing isn't handled perfectly. Let's run some numbers using our canonical batch of 2 million gallons of renewable diesel. Now, generating that batch in the physical book creates 3 million D4 RINs. If we use a modeled internal price of $1.20 per RIN, that creates an internal transfer value of $3.6 million. That value moves from the physical book, which generated the RINs, over to the credit book, which is now going to manage them. But here is the trap, and it catches so many desks off guard. If both desks claim that $3.6 million as independent profit without running a group elimination, your desk just double counted $3.6 million. It's literally like taking a $100 bill out of your left pocket, putting it into your right pocket, and telling your boss you just made $200. It is an auditor's worst nightmare. Your physical root's actual modeled economic advantage is just over $1.2 million, but sloppy transfer pricing completely distorts the reality of your performance. All right, Section 4. Obligated blenders versus credit traders. We have to look at the market through the absolute defining lens of this entire industry. This perfectly illustrates the market inversion I teach to trading teams all the time. Imagine we get a $50 per ton rally in feedstock prices. On our canonical batch, this rally costs the physical, obligated blender over $329,000 in direct modeled losses. Their economics are bleeding. But what about the pure credit-only trader sitting across the floor? They don't hold physical fuel, so their physical loss is 0. To them, this feedstock rally is just a signal. It tells them credit supply might tighten up, making it a great time to buy credits. It's the exact same market event, but it triggers entirely opposite desk reactions.
Which leads us perfectly into Section 5. Hedging cannot fix compliance. This is where we run into the very hard, very real boundary between financial risk and statutory mandates.
I love asking trading teams this question. Let's say your paper desk makes an absolute massive profit on a cash-settled diesel swap. Great, right? But what if, at the same time, your physical desk had a plant outage and failed to generate enough RINs? Are you safe? The answer is a resounding, definitive no. A regulator who is demanding a valid compliance unit does not care one bit about your profitable derivative. They want the specific, eligible, scheme-approved regulatory asset. You literally cannot hand them cash in place of a RIN. Remember, paper hedging protects your economics. Valid credit inventory protects your compliance. The compliance deadline is a hard, unforgiving gate. It is not a cost you can just trade off. Money and compliance operate in completely different dimensions. And honestly, it gets even more dangerous than that. You absolutely must treat validity exposure as a catastrophic first-order risk. A credit that has been generated, sold, settled, and even surrendered to the EPA can be retroactively invalidated long after the fact. Maybe there was upstream fraud with used cooking oil in the supply chain. It happens. If a RIN is voided, your compliance obligation instantly springs back to life. The regulator still doesn't care about your paper profits. You owe them a valid unit. This is exactly why origin provenance is so paramount and why regulatory change, including retroactive change, actually sets the price of these assets rather than just acting as some theoretical scenario overlay.
Let's bring it all together in Section 6, the 3-book exposure map. If you want to survive this kind of complexity, you absolutely cannot run this business on a basic spreadsheet that just says you are long.
This matrix right here, this is your control artifact. It separates your physical molecules, your paper hedges, and your credit assets into their own distinct rows, complete with their specific statuses. But crucially, it takes all three and reconciles them against a fourth ultimate view, the net compliance exposure. Because, let's be honest, having 3 million RIN sitting in your account looks fantastic until you realize your mandate obligation actually requires 5 million, leaving you dangerously short. Separation gives you accountability across the desks. Linkage gives you your portfolio truth. So I'll leave you with this. Do you truly definitively know your net compliance position today? Or are you just staring at gross inventories and paper profits, hoping it all works out? Keep that provocative question in mind as you look at your own desk's operations. As we transition into Chapter 4, we're going to strictly assign the trader, compliance, and operations responsibilities you need to make this exact architecture function flawlessly. Thank you so much for joining me on this explainer, and I will see you in the next chapter. Welcome back to this explainer for the Biofuels and SAF Trading Desk Master Program. I'm your host, a Biofuels and SAF Trading Desk consultant from Durga Analytics. Over my career, I've run compliance books against statutory blending mandates, and I've managed speculative credit books driven entirely by market views. I've sat on both sides of the RIN, LCFS, and RED markets, designed the ETRM systems that hold the physical fuel and compliance positions, and taught these exact mechanics to working professionals. Today, we're unpacking exactly who owns what decision on a biofuels desk, and why confusing accountability with execution responsibility is frankly a massive economic exposure. Here is our game plan for today. We'll map out the course, define the 3 core desk functions, walk a massive REN trade through its operational life cycle, contrast how obligated versus credit-only desks react to the exact same event, lock down our gate logic, and finish up with how we track all of this in an ETRM system. Section 1, Course Map and Chapter Focus. Let's quickly anchor where we are in our sequence journey. The Biofuels and SAF Trading Desk Master Program spans 8 modules across 110 chapters. Now, sitting right at the front is our primer annex, which covers chapters 0.1 through 0.14. Those aren't counted in the main 110 chapters, but they establish our foundation. We are currently navigating the very first of the 8 modules, what a biofuels and SAF desk really is, landing exactly at Module 1, Chapter 4. Previous chapters built our physical, paper, and credit books. This chapter adds the next absolutely vital layer: who is actually allowed to decide what? Section 2. 3 roles, 3 different questions. So, a trading desk fails when it jumps from a market signal straight to execution without independent permission gates. Let's look at how these roles completely diverge on the desk. Trading is asking, should we do this? Because they're incentivized by P&L and market timing. Compliance is asking, are we permitted, driven entirely by risk prevention and regulatory correctness? And operations? They're asking, can it actually complete, prioritizing settlement accuracy? These 3 truths must exist simultaneously. A trader might say, hey, we executed at $1.20. Compliance jumps in with, the instrument is appropriate, subject to evidence, and operations finishes with, well, the transfer hasn't cleared the registry yet. Commercial execution absolutely does not equal operational completion, and operational completion does not automatically equal regulatory validity. Section 3. The 3 million RIN scenario. Let's put some real numbers to this. Imagine we're dealing with 3 million D4 RINs at a canonical base modeled price of $1.20 per RIN. That is $3.6 million in immediate regulatory asset value. But under our modeled stress scenario, the replacement cost jumps to $1.50 per RIN, creating a massive $4.5 million exposure. That's a $900,000 stress increment. If trading controls the price, the eligibility, the evidence acceptance, and the registry completion without any independent challenge, you are literally flying blind. You have one person deciding if every control problem is acceptable. Responsibility ambiguity isn't just an annoying org chart issue, it's a massive, quantifiable economic exposure. Notice how physical throughput plays out over time. Trading might initially forecast 2 million gallons, but operations measures exactly what actually arrives, which is 1.96 million gallons. Then, after a quality exception, where some material fails the specification release test, only 1.94 million gallons are fully supported by evidence. In RIN terms, that drops our expected 3 million RINs down to 2.91 million. Suddenly, we have a 90,000 RIN documentation gap. Trading cannot just override operations measured quantity to fix their P&L. Physical throughput belongs to operational evidence, not commercial forecasting. And here is the absolute kicker. Operational completion is not regulatory perfection. You might see a clean transfer in the EMTS registry, but that doesn't prove the original generation was permanently valid. Retroactive invalidation is a first-order risk in this market. A compliance credit can be generated, sold, settled, and even surrendered, but voided long after the fact. And when it is voided, your compliance obligation returns. The money is gone, and you still owe the mandate. This is why compliance has to constantly guard the eligibility gate, treating the compliance deadline as a hard gate with a status, not just some negotiable cost to be traded off. Section 4. Obligated versus credit-only desks. What happens when evidence is delayed? Well, differing desk incentives drive completely opposite reactions to the exact same exception. Imagine a 300,000 RIN slice of our trade is lacking seller lineage evidence. An obligated desk holds a position because a statutory mandate runs against its physical fuel. They're short, by definition, so they might execute the 2.7 million fully supported RINs immediately just to secure their verified slice, and conditionally pause the remaining 300,000 to limit completion risk. But a credit-only desk? Their position is purely elective, based on a speculative market view. They might just walk away entirely or wait until the evidence uncertainty drops to 0. Same controls, completely opposite commercial decisions. Section 5. Gate logic and stop authority. Before any major operational move on the desk, you must always ask this foundational question.
What is the next irreversible action? Is it signing a contract, paying an invoice, submitting a regulatory claim? You need to know exactly who owns that action, who can stop it, and what exact evidence permits a restart. Remember, control intensity must rise as irreversibility falls. If a control function uses their stop authority, that veto has to be rigorous. It needs to find regulatory or operational grounds, like missing seller lineage evidence or registry transfer remains pending. Vague stops like, "we are uncomfortable," only create vague restarts. And no, the trader cannot self-approve a restart. The stop record must state exactly what evidence is required and name an independent restart authority. A veto is a hard stop on defined grounds. It is definitely not compliance trying to play trader by suggesting a different commercial strategy.
Section 6. ETRM and the next trick. Your ETRM dashboard might show a 99% average completeness score across identity, economics, and liquidity, but you cannot average your completeness scores to pass a gate. If 3% of your evidence is missing, like our 90,000 unsupported RINs, that is a hard gate failure, not a passing grade. One missing critical document can stop the entire regulatory claim. The system must track state history, from active to quarantined, just as rigorously as it tracks price history, because usability changes dramatically even when the price doesn't move a single cent. I want you to walk away remembering this cardinal rule for the biofuels desk. The person who benefits from executing the trade should never, ever be the only person who can declare the trade eligible, valid, and complete. Segregation of duties isn't bureaucratic red tape. It's the fundamental mechanism that prevents an apparently profitable action from silently consuming your compliance capacity or your firm's liquidity without a reversible path. This chapter established exactly who does what, setting our internal boundaries and accountability. And that perfectly sets us up for Module 1, Chapter 5. Now that we know who makes the decisions, Chapter 5 will lock down exactly how much capital, how much position, and how much market risk each trader is actually allowed to take. So who really owns the risk on your desk? Think about that, and I'll see you in the next explainer.
Welcome back to our explainer of the Biofuels and SAF Trading Desk Master Program. I'm your host, a Biofuels and SAF Trading Desk consultant from Durga Analytics. Over the years, I've run compliance books against statutory blending mandates, I've traded speculative credit books against a market view, and I've designed the ETRM systems that actually hold all this together. Today, we are going to completely shatter the beginner illusion that a trading desk mandate is just a dollar VAR limit. Honestly, if you think a simple risk budget is the only thing defining your freedom on the desk, you are setting yourself up for some catastrophic, unbudgeted risks.
Just a really quick reminder of our sequence journey here. This program is a massive deep dive spanning 8 modules and 110 chapters, taking you from market structure right through to systems and leadership. We are currently right in the thick of Module 1, Chapter 5, and this builds directly on our uncounted primer annex, that's Module 00, Chapters 0.1 through 0.14, to explore what a desk is actually authorized to do and exactly how much exposure management is deliberately allowing you to take.
Okay, let's take a quick look at today's agenda. We're covering Welcome to the Mandate, the 6 mandate axes, 3 independent survival constraints, policy shock and validity crisis, obligated versus credit-only desks, and finally, escalation and deadline governance.
Let's dive right into Section 1, Welcome to the Mandate.
So if you think a $15 million risk limit is a complete mandate, you're missing the most crucial details. For my time structuring these exact limits, I can tell you a simple dollar amount doesn't actually tell you if the trader's authorized to buy physical sustainable aviation fuel, sell D4 RINs, or hold unverified credits. You see, the mandate's job isn't to magically promise that losses won't happen. Its job is to ensure the type and the scale of any potential loss was knowingly authorized by management. It is literally the absolute boundary of your delegated commercial freedom.
Which brings us to Section 2, the 6 mandate axes.
We have to construct a mandate along these 6 specific axes. These turn a really vague permission like, hey, you may trade biofuels, into a precise governance tool. You need to define your desk position like, are you physical, paper, or credit? You need size limits, both gross and net, because a flat net position can still hide massive operational risks. You have to define the permitted instruments, the required capital and funding, and a risk budget that explicitly names the exposures. And crucially, absolutely crucially, you need Axis 3, tenor.
And this right here brilliantly illustrates why tenor has to be an independent axis. Consider these 2 scenarios. Let's say your mandate only has an annual volume limit of 1 million gallons. Well, a trader could sign a 1-year contract committing the firm to a $2.4 million net premium scale. Or, under that exact same annual volume limit, they could sign a 10-year contract. The annual volume hasn't changed at all, but they've just created a massive $24 million commitment. If tenor isn't strictly bounded, your true scale of risk is just completely hidden.
Let's move on to Section 3. 3 independent survival constraints. This first pillar is our canonical $15 million risk budget. It answers one very specific question. How much modeled and defined market risk does management actually permit this desk to accept?
Then we have the second pillar, your $25 million liquidity headroom. This is measuring your committed cash capacity. It answers whether you actually have the working capital in the bank to support the positions you want to take, fund your inventories, or post margin.
And the third pillar is your $40 million counterparty credit limit. This tells you exactly how much counterparty exposure is approved across your specific trading partners.
Now listen carefully because this is a mistake I see all the time. Never add these together. You do not have $80 million in combined capacity. Think about it. A position can perfectly fit your $15 million risk budget and perfectly fit your $40 million credit line. But if you don't actually have the cash on hand, it completely fails the liquidity constraint. These limits bind independently based on the desk's daily dynamic state. Whichever one hits its ceiling first, that is your binding constraint for the day.
Moving to Section 4, Policy Shock and Validity Crisis.
I want you to really notice the ranking of these threats. A standard $50 per ton jump in feedstock prices, that consumes just over 2% of your risk budget. But look at the top of the table. A 7% policy shock to your obligation volume consumes 35% of your budget. And right below that is a biofuels trader's first-order nightmare, retroactive RIN invalidation. This is when credits you've already generated, sold, or even surrendered are suddenly voided by regulators long after the fact, returning the obligation directly back to you. That eats 30% of the budget. So, relying on standard market price VAR alone is totally insufficient. Quantity and validity are your true first-order risks.
Furthermore, you absolutely have to watch how price regimes alter your limits. Say your fixed risk budget is $15 million. Well, at a base price of $1.20 per RIN, that budget allows you to hold a physical scale of 12.5 million RINs. But if market replacement prices rise to a stress level of $1.50, your physical survival capacity just shrank to 10 million RINs. Without changing a single internal rule on the desk, a price jump just reduced your physical unit capacity by 20%.
That brings us to Section 5, Obligated versus Credit-Only Desks.
This is where the reality of your desk completely defines your reaction. If you're sitting on the obligated blending desk, your position exists because a mandate runs against your physical fuel. If a policy shock creates a 3.5 million RIN compliance shortfall, you must secure those units. Even if your internal risk budget is completely maxed out, you cannot just ignore external law. You have to escalate and solve it. Whereas the credit-only desk, holding positions strictly on a speculative price view, lives in a totally different reality. If their risk budget is breached, they simply refuse the trade and walk away.
Same exact market event, totally opposite reactions.
And finally, Section 6, Escalation and Deadline Governance. Because the obligated desk cannot walk away, time literally becomes a risk budget dimension. Let's say you have a hard shortfall of 3.5 million RINs with 90 days left to the deadline. You only need to close about 39,000 RINs per day. Very manageable. But if you delay and suddenly you're at day -10, your required closure pace skyrockets to 350,000 RINs per day. Your execution optionality just evaporated. The total quantity hasn't changed at all, but the operational urgency just multiplied 9 times over.
Ultimately, remember this: a mandate is not a wall with no door. If you need 3.5 million RINs to comply with the law, but your internal risk budget only permits 3 million, you have an internal governance conflict. What you don't have is a smaller regulatory obligation. You can't use an internal company limit to pretend external federal law just disappeared. When these two things conflict, you absolutely must escalate it upward to management before that deadline hits to find a governed solution, whether that means reallocating capital, releasing budget, or finding a new physical pathway.
So your mandate is set, your limits across all 6 axes are meticulously defined, and the absolute boundary of your commercial freedom is crystal clear. But here is the ultimate question for any trader. If a trade perfectly fits your budget, perfectly fits your credit, and fits your liquidity, does that automatically mean you should execute it, or are there times when surviving this market means intentionally walking away from a perfectly legal, perfectly bounded profit? Think about that for a minute, because that is exactly what we are covering next in Module 1, Chapter 6, When Not to Trade Biofuels. Thanks so much for joining this explainer, and I'll see you in the next chapter.
Welcome back to the explainer for the Biofuels and SAF Trading Desk Master Program. I'm your host, a Biofuels and SAF Trading Desk consultant from Durga Analytics. Look, today we are tackling a skill that separates the pros from the rookies on the desk, and that is the discipline of governed refusal. We're going to dive into exactly when and why you should actively look at a trade and say no, even when the mandate and your risk limits are telling you yes. First up, just a quick reminder of our overall course map. Remember that our primer module, Biofuels from Zero, which covers annexes 0.1 through 0.14, sits right before Chapter 1 and is not counted in our main 110 chapters. The core program spans these 8 modules. Module 1, what a biofuels and SAF desk really is. Module 2, market structure and regulation reality. Module 3, senior trading and structuring playbooks. Module 4, valuation, credits, and model skepticism. Module 5, risk, credit, and compliance survival. Module 6, execution, logistics, and operational risk. Module 7, systems, ETRM, and credit tracking. And finally, Module 8, behavior, accountability, and leadership. Right now, we are zooming into Module 1, Chapter 6. All right, here's our structured roadmap for today. 1. The screen edge illusion. 2. The 5 veto gates. 3. Retroactive invalidation risk. 4. Obligated versus credit only. And 5. The no trade decision record. Let's get right into it. Section 1. The screen edge illusion. We're going to dismantle the myth that a green light from compliance means a trade is actually a good idea. As traders, we are naturally hardwired and paid to find opportunities and trade them. Walking away? Well, that often feels like failure, doesn't it? But here's the reality check. If your internal compliance framework says a trade is permitted, that is just a boundary. Permission is necessary, but it is absolutely not a recommendation. Deliberately keeping your optionality open when the quality of evidence drops is an active, strategic capital decision. You are protecting your license to operate. Let's break down how this illusion collapses in real life. Imagine your pricing model says fair value is $1.04, but the screen headline is sitting there at 96 cents. On a 4 million RIN position, that looks like a beautiful $320,000 edge. But the trade doesn't just have one magic price. Once we apply a size reserve, because we need a massive 4 million units, not just the tiny screen quantity, our executable edge shrinks down to $120,000. Boom, over 60% of your opportunity just evaporated. Then you notice the documentation is weak, so you apply an evidence reserve. Suddenly, your edge turns completely negative, dropping to minus $120,000. A headline win just turned into a massive real-world loss. And the stakes here are massive. Moving from our current canonical base mark of $1.20 to a stress replacement cost of $1.50 on 4 million RINs, that creates a massive $1.2 million stress increment. That single sloppy decision can literally devour up to 40% of an entire risk budget. So, Section 2, the 5 veto gates. How do we systematically catch and reject these dangerous trades before they happen? We use absolute veto gates. You have to test economics, eligibility, validity, liquidity, and compliance timing. The absolutely crucial thing to remember is that these are vetoes, not a weighted average. If a trade gets an 80% overall approval score but fails the validity gate, it is a hard no. You can't just be 80% compliant with a regulatory claim. Let's look closely at liquidity, specifically executable depth, because this dictates your days to exit. If your stress depth suddenly halves in the market, a 4 million RIN position suddenly turns from an 8-day exit into a completely trapped 16-day nightmare. Your position size always has to be determined by the exit, not the entry. Moving on to Section 3, retroactive invalidation risk. This is the ultimate hammer of reality in the biofuels ETRM system. You'll hear traders say, the registry looks clean, let's execute. Nope, that is a fundamentally weak answer. A clean onboarding checkbox in your ETRM just confirms a recorded transaction state. It doesn't prove future validity. Because if a credit's upstream lineage gets challenged by regulators down the road, that credit is retroactively voided. And when it gets voided, your physical compliance obligation immediately returns. Validity is a first-order risk that sets your price. It is not just some hypothetical scenario overlay. To put that into perspective, look at lineage concentration risk. Even if just 25% of your 4 million RIN position shares one disputed upstream lineage, you are in trouble. Transaction diversification is not lineage diversification. A single evidence issue on that 1 million RIN chunk creates a $300,000 stressed replacement headache. If validity is weak, rejecting the trade is how you preserve your firm's license to operate. Section 4. Obligated versus credit only. Now, we take these exact same numbers and walk them through the two primary lenses of the desk, where identical information produces opposite decisions. We call this the paired inversion of time value. For a speculative credit-only trader, if the evidence is weak, they just wait. They have no terminal shortfall to worry about. Waiting preserves their optionality, and sitting flat in cash is perfectly safe. But the obligated blunder, they have a ticking mandate clock against their physical fuel. Waiting literally destroys their completion optionality. So when the obligated desk refuses a batch of weak credits, they aren't rejecting the mandate itself. They are actively rejecting a specific, risky route so they can go secure a safer compliance path. And for the obligated desk, make or buy economics are purely conditional. Say feedstock spikes push the physical generation cost of a RIN to $1.35, but you look at the screen and valid market credits are sitting at $1.20. On 4 million units, the obligated desk will actively refuse physical production to save $600,000 and simply buy the credits. The mandate doesn't care how you comply, it just cares that the credits are valid. All right, our final section, the no trade decision record. Let's see how this discipline translates into a concrete artifact on the desk. Without a formal log, trading discipline just becomes desk folklore. A refused transaction needs to leave a record, just like an executed one. You have to document the proposed edge versus executable economics. You specify exactly which veto gate it failed, and log the reason code. Crucially, for the obligated desk, you document the alternative route you secured. And finally, the restart condition, meaning what specific piece of new evidence would trigger the desk to reevaluate this trade. This log is your defense against the hindsight trap. Imagine you reject a trade at $1.20 because the evidence is a mess, and then a week later the market rallies to $1.50. You know management is going to march over and ask, why didn't we buy at $1.20? A senior desk defends a refusal not by pointing to later market moves, but by pulling this exact record and proving that evidence, liquidity, and executable depth utterly failed your strict release thresholds at the exact time of the quote. So, I'll leave you with this final provocative thought. We've clearly established today that sometimes the best trade on the desk is the one that never enters your blotter. But if non-trading is an active capital decision, how do we systematically distinguish which control points belong to elective speculation and which belong to mandatory compliance execution? Think about it, because if you don't know, your framework is already broken. In Chapter 7, we'll take the refusal discipline we built here and answer exactly that. Thanks for joining this explainer, and I will see you on the desk in the next one. Welcome back to The Explainer, everyone. I'm stepping in today as your Biofuels and SAF trading desk consultant from Durga Analytics. Over the years, I've actually sat on both sides of this market, running compliance books against statutory blending mandates and running speculative credit books strictly against a market view. I've worked across RIN, LCFS, and red markets, built the ETRM systems that track them, and trained desks on how to manage this stuff. Today, we're jumping into Chapter 7 of our master program, and we're tackling the fundamental tension of literally any biofuels desk, speculative intent versus compliance survival. Okay, let's dive right in. Just to quickly orient us in our 110-chapter journey, we are currently in Module 1. Remember that Module 0 Primer Annex, Chapters 0.1 through 0.14, sits entirely before Chapter 1 and isn't included in our 110 count. So Chapter 7 puts us right in the thick of understanding how a desk actually controls its positions in the real world. Here's our agenda for this session. Section 1, 2 desks, 1 credit. Section 2, the threat of retroactive invalidation. Section 3, the stop-loss trap. Section 4, declaring position purpose. And Section 5, the speculation overlay. All right, starting with Section 1. 2 desks, 1 credit. Identical instrument, opposite mandates. Let's start with a core paradox of this business. I want you to imagine identical twins. I mean, the exact same D4 RIN, from the exact same vintage, sitting at the exact same market price. But these twins, they live in 2 totally different houses. On one hand, you have the obligated desk. This blender starts with a mandatory denominator, a strict obligation generated by their physical fuel, so they absolutely must secure hard coverage. On the other hand, you have a credit-only desk. They start at 0. They're just choosing to take on market exposure to turn a profit. Physically, electronically, the asset is totally identical. Economically, the position is absolutely not. Let's put some real numbers to this to see what I mean. We'll use our constructed Chapter 7 shock scenario. Say we have a reference obligation of 50 million RINs. Now, apply a 9% regulatory or market shock to that requirement. Boom, you're left with an affected quantity of 4.5 million RINs. This isn't a rounding error, folks. This is a highly material compliance shortfall that a desk has to solve and solve immediately. And that translates to a massive financial scale. Look at our current cumulative course overlay for a D4 iron. Our modeled base price is $1.20. So fixing that 4.5 million iron requirement creates a $5.4 million base replacement cost. But what if the market moves into a stress scenario at, say, $1.50 per iron? That exact same compliance gap just ballooned to a $6.75 million replacement cost. That's a $1.35 million hike just for market stress. If you're a speculator, well, that's just a bad day for price risk. But if you're an obligated party, that is your survival on the line. Which brings us to Section 2, the threat of retroactive invalidation, when credits return from the grave. Now, traditional traders usually only obsess over price exposure, right? But in biofuels, you face something called state exposure. This is the economic consequence of a change in regulatory status without a single cent moving in the market price. Imagine your 4.5 million RINs suddenly go from active to quarantined because of some lineage dispute. Your price chart looks completely flat and fine, but your hard compliance coverage literally just evaporated by 4.5 million units. This is the ultimate boogeyman of compliance trading, and it hits our two desks completely differently. If a speculator's credits are retroactively invalidated, they face asset impairment. It hurts. They lose their money, wipe the trade, maybe pay some legal fees. But the obligated party? They suffer that exact same asset impairment plus a restored compliance obligation. That 4.5 million RIN shortfall literally returns from the grave, and now they have to go out into a potentially stressed market and buy them all over again. Compliance deadlines are hard gates, guys, not just financial costs you can trade off.
Let's look at how systems handle this in Section 3, the stop-loss trap. How standard risk controls destroy compliance.
This is a classic failure chain where standard, out-of-the-box risk tools literally blow up a firm. Step 1. The obligated firm smartly buys its required RINs at $1.20 to cover its mandate. Good job. Step 2. The market price drops to $1.10. Step 3. A generic ETRM system, which is completely blind to why you bought those RINs, triggers a standard stop loss and automatically sells your inventory to protect the P&L. Step 4. Congratulations! You've successfully limited your financial loss, and you've just triggered a catastrophic illegal regulatory shortfall. Time to dust off the resume, right? So please burn this axiom into your memory. Selling proprietary inventory reduces market risk. Selling compliance inventory recreates a regulatory shortfall. That is exactly why standard market risk limits absolutely cannot be allowed to blindly force the sale of mandatory compliance assets. They have to know the purpose of the asset. Moving to Section 4, Declaring Position Purpose, Fixing the ETRM Solution. Imagine you're sitting in an interview for a senior desk role, and they ask you, why do I care about position purpose if the RIN price is the exact same? If you shrug and say, you shouldn't, price is price, well, thanks for coming in, the interview is over. The correct answer is, because purpose dictates what actions are permissible. The identical price exposure requires two completely opposite control responses, depending on whether you're holding a mandate or holding a view. To fix the ETRM trap we just talked about, your systems and your traders have to explicitly declare position purpose before a quote, trade, or reservation ever happens. You need these 5 critical tags: compliance, trading, buffer, pending, and quarantined. Because if your system just gives you a blanket, hey, you're long 6 million RINs, it is functionally useless. You need to know exactly which slice of that 6 million is legally locked away for compliance and which slice you can freely trade. And this has massive governance implications. Moving inventory between these tags, which we call reclassification, literally changes your firm's hard regulatory coverage state. If a trader suddenly decides to move units from trading to compliance or vice versa to free up inventory for a quick sale, they cannot just do that on a whim. It demands explicit release authority, a stop and restart check, and a time-stamped audit trail. You are essentially shifting the legal armor of the entire company. All right, Section 5, the speculation overlay, when blenders take a view. Look, an obligated desk isn't automatically banned from speculating, but it has to be rigorously defined. Let's break down a 7 million RON purchase. 4.5 million is your hard, non-negotiable compliance requirement. Another 500,000 is an approved buffer just for resilience. What's left? 2 million RONs. That slice is purely an elective, discretionary speculative overlay. It is absolutely vital to separate this out, because if a risk limit is breached, your systems must know to sell from that 2 million speculative slice first, protecting your mandatory 4.5 million. And keep in mind, speculation isn't just about buying extra credits. Deliberate market timing is a massive form of speculation. If you have a known hard short of 4.5 million RINs, and your trader says, hey, let's wait to buy, I think prices are going to drop from $1.20 to $1, they are taking a speculative timing bet using mandatory compliance capacity as collateral. As that regulatory deadline creeps closer, that bet shifts from being a clever execution strategy to a critical survival risk. It requires explicit, tightening limits the closer you get. To put that into perspective for your desk's resources, earlier we showed that a 4.5 million RIN replacement under stress costs $6.75 million. If your whole desk has a risk budget of $15 million, that single stress event just ate 45% of your entire budget. Therefore, your capacity priority has to be strictly ordered. 1. Mandatory compliance. 2. Approved buffer. And 3. Discretionary speculation. Speculative overlays can never, ever be allowed to crowd out your baseline compliance survival. So, bringing this all together for your desk governance. At a corporate level, you absolutely should standardize your data inputs, your evidence requirements, and your validity taxonomy across both your obligated and speculative desks. But you must never standardize the final position or required actions. Forcing a blender and a speculator to react identically to the same price drop destroys value. Why? Because an incredible market opportunity for a speculator might be a fatal missed deadline for an obligated blender. I'm going to leave you with this final concrete rule of thumb. If you're a professional sitting on a biofuels desk, never just ask, what is our RIN position? You have to ask, why do we own it? Because price tells you what the asset is worth, purpose tells you what you are actually allowed to do with it. And that wraps up our session on speculation versus compliance. But it does leave us with a pretty dangerous question. If standard risk systems can accidentally auto-sell your company into a federal violation, what other landmines are sitting hidden in your firm's ETRM right now? We are going to answer exactly that in Module 1, Chapter 8, where we explore the fascinating failure chain of how actual biofuels books structurally collapse. It's going to be a good one. Until then, keep your purpose tags clear and your coverage hard.
Welcome right back to our explainer for Chapter 8 of the Biofuels and SAF Trading Desk Master Program. I'm your host, a Biofuels and SAF Trading Desk consultant from Durga Analytics. Over the years, I've sat on both sides of these markets, running statutory blending books against mandates, trading speculative credits on a view, and actually designing the ETRM systems that hold the physical fuel and compliance credits. Today, we're shifting from high-level market theory into the gritty, operational reality of desk survival. Because honestly, when things go wrong on a desk, they rarely go wrong the way people think they do.
So let's get our bearings real quick. As a reminder, this course is a sequenced journey across 8 modules in 110 chapters. We've already powered through the 14-part primer annex. Those are chapters 0.1 through 0.14, which sit before Chapter 1 and aren't counted in the 110. Right now, we're deep into Module 1, really breaking down what a desk is actually accountable for before we start trading in the wild.
And that brings us to the core thesis of today's analysis. It's incredibly simple but profound. A biofuel desk failure is rarely one bad price. When you see a massive financial blowout, it's almost never a single bad guess by a rogue trader hitting the wrong button. Instead, it's a slow-moving train wreck of unresolved dependencies. It's a chain reaction. And that final cash loss you see, that's just the visible consequence at the very end of the line.
Here's our roadmap for this explainer. We'll deconstruct the anatomy of a desk failure, run the math on a 5 million RIN case, split the view between obligated and credit-only desks, bust the complete registry myth, and wrap up with a Monday morning desk playbook.
Let's dive right into Section 1, the anatomy of a desk failure. We need to look under the hood at how an irreversible position actually gets built.
Now, the very first rule of failure reconstruction is getting your vocabulary straight. You've got to separate your categories. An observed fact is evidenced reality. A model number is a calculation based on program assumptions, and a counterfactual is a control action that could have occurred but didn't. Listen, you must never add these three together as if they were equal evidence. If you do, you'll end up with your risk team literally chasing ghosts instead of fixing the actual leak in your process.
The anatomy of a failure always follows this exact six-stage path. It starts with an attractive market signal, usually a great price that accelerates action. Then comes an assumed scope, where generic labels replace exact legal identities. Third is incomplete evidence, where transaction status is mistakenly treated as foolproof. Fourth is irreversible commitment. Fifth is the discovery that something actually failed. And finally, the consequence, where the loss hits the P&L long after the original mistake was made.
If we map this out chronologically, from the initial quote at T0 all the way to mandatory replacement at T4, T2 is the real villain here. T2 is the critical breakpoint. This is where the trader commits unresolved volume, causing the reversibility of the trade to drop sharply. The control failure isn't that the evidence later failed at T3. The failure was committing that unresolved slice at T2 as if its status were perfectly complete.
All right, moving on to Section 2. Let's put some actual dollars to this to understand the P&L velocity of that T2 mistake. We're going to apply some real desk math to a 5 million RIN reference exposure.
Under the source chapter's modeled arithmetic, the math gets scary fast. The difference between a base mark of 78 cents per RIN and a stress replacement cost of $1.15 creates a sudden $1.85 million gap. That right there is the kind of shock that completely ruins a compliance manager's morning when a position suddenly fails a status check and they're forced into the market to replace it. Now, keeping with our broader program continuity, we've been using a cumulative D4 overlay. If we apply that, jumping from a $1.20 base to a $1.50 stress, that exact same 5 million RAN quantity generates a $1.5 million replacement shock. It's super important to keep these two models separate in your head, but both perfectly highlight why you can never, ever evaluate a transaction purely from the headline mark. Which brings us to Section 3, obligated versus credit-only desks, because this is where the plot really thickens. And that financial shock fundamentally alters reality depending on your mandate.
This is arguably the most critical distinction in the entire biofuel space. If you're an obligated party, your main objective is protecting completion. So if a credit is retroactively invalidated, you face asset impairment plus a terrifying restored statutory shortfall. The obligation literally comes back to life, and you have to physically replace that coverage. But if you're a credit-only trader, your goal is to protect elective capital. Sure, you suffer capital impairment and liquidity costs, absolutely. But you hold zero reference obligation. When the dust settles, your required position is zero. The exact same market event pushes these two desks in completely different risk directions.
And that first-order risk of retroactive invalidation leads us straight into Section 4. It exposes one of the most dangerous assumptions a compliance manager can make when staring at their screens.
Registry complete does not automatically equal valid forever. A clean registry simply tells the desk the recorded transaction state. That is it. It does not independently prove the full underlying evidence chain, the pathway, the seller lineage, or the life cycle status. Regulatory change or retroactive invalidation can void a credit long after it was generated, sold, settled, and even surrendered. Think of it like buying a certified pre-owned car, only to have the DMV revoke the title 3 years later because the original factory paperwork was fake. You don't just lose the money, the regulatory obligation returns.
We see this vividly in the EU transfer case. Just look at how the RED 3 route and the Refuel U route diverge. A physical SAF molecule can be completely, successfully delivered, pumped, and paid for. It's technically usable fuel.
Yet the intended Refuel U regulatory claim might remain totally unsupported because specific supplier evidence or Union Airport scope wasn't met. Physical delivery does not equal documentary completion.
And this is exactly why a desk can never net unmatched legal units. You cannot offset U.S. RIN value against an EU SAF obligation as if they were interchangeable. Economically? Sure, your group risk team can compare the USD and EUR consequences, but legally and operationally? No way. The physical fuel might be similar, but the legal instruments, the compliance uses, and the evidence chains are entirely separate. Never net them.
So, we understand the failure chain, the math, the desk types, and the registry myth. Now for Section 5. How do we operationalize this deeply structural knowledge to actually protect the desk before the next trade? A senior, well-run desk implements these 5 strict controls immediately. First, add status to your position reporting. Don't just say quantity times price. Use tags like quarantined. Second, isolate exceptions by exact quantity. Don't say some documents pending, say 250,000 RINs affected. Third, record the next irreversible action. Fourth, pre-price your replacement liquidity before the evidence actually fails. And finally, give every single exception a name, stop, and restart owner. Nothing should just sit indefinitely under review with compliance. Under review is literally where desk profitability goes to die.
To support all this, your ETRM architecture has to step up. It must move beyond simple price and quantity. You need to capture specific compliance fields, especially applicability and exception data. If your system can only reconcile commercial quantities, you're going to entirely miss the status exposure that suddenly recreates a regulatory obligation out of thin air.
Ultimately, the goal of a robust postmortem isn't to witch hunt and ask who lost the money. The real goal is to trace back to this exact concept, the first preventable link. This is the earliest point where information and authority, which were reasonably available at the time, could have broken the chain. Finding that one control attached to an action somebody already performs is how you stop the bleed next time. So I want you to look at your own desk right now. Are you entirely sure your current profits aren't just an illusion built on unresolved evidence? Understanding this chronological chain perfectly tees up our explainer for Chapter 9, where we'll dive into the senior view of Biofuel Desk P&L to make sure your profitable trading book isn't secretly hiding a deteriorating compliance position. Thanks so much for joining me, and I'll see you in the next explainer.
Let me throw a classic senior desk question your way. Imagine you're looking at your team's aggregate P&L report for the month, and it says, the desk made $2 million. So, good month? It's the most natural question in the world, right? And if you're looking at aggregate profit, it's exactly what you'd ask. But if you're running a serious biofuels operation, the actual answer might surprise you.
Here is the desk-ready answer. Not enough information. Why? Well, because a positive financial result can easily, and I mean easily, coexist with a worsening mandatory compliance position. Your top-line profit can absolutely mask a massive compliance failure. As we're going to see today, you can report a highly profitable month while simultaneously blowing a multi-million-dollar hole in your regulatory compliance.
Welcome back to The Explainer. I'm a biofuels and SAF trading desk consultant from Durga Analytics, and I spend my days running compliance books against statutory blending mandates, running speculative credit books against market views, and designing the ETRM systems that actually hold all these physical fuel and provenance positions. Today, we're looking at exactly how a desk head reads the numbers. Let's dive right into Chapter 9, the senior view of biofuel desk P&L. Just a real quick reminder on where we are in the Biofuels and SAF Trading Desk Master Program. It's a sequence journey across 8 modules and 110 chapters. Remember, the primer annex, chapters 0.1 through 0.14, sits right before Chapter 1 and isn't counted in that 110. Right now, we're on Chapter 9, which means we are officially wrapping up Module 1, what a Biofuels and SAF Desk really is.
Here is the agenda for our forensic investigation today. We're covering the illusion of profit, the P&L bridge, the double count trap, status exposure, the critical differences between obligated and credit desks, and we'll finish up with the senior dashboard. Let's start with Section 1, the illusion of profit. So why is a single aggregate P&L number just outright dangerous? Because aggregate P&L only tells management if reported economic value went up or down. It doesn't tell them why. To fix this, before we analyze a single number on a desk, we have to establish what we call epistemic discipline. This is the strict separation of categories. Observed means evidenced facts, actual reality. Modeled means it's calculated from your assumptions. And counterfactual is the result of an event or control action that didn't actually happen. If you're a risk manager or an ETRM professional, you know these categories literally have to remain separate. If you mix them up, you're trading illusions. Moving to Section 2, the P&L bridge. Now that we have our discipline, let's deconstruct that aggregate profit line by line. What's really fascinating here is the mindset. A desk head reads this bridge before they ever look at the total P&L. Let's break it down. Physical margin asks, did the molecule itself create or consume value? Paper hedge P&L asks, did the financial hedge actually offset the intended risk? Credit P&L looks at realized trading and carry. Basically, was value created by the market or just transferred internally? Compliance cost asks if your obligation is safer. Internal transfers allocate value book to book, but listen, they absolutely must eliminate on consolidation. Finally, the unexplained line. This is your residual. It asks, what changed that the desk hasn't explained yet? Pro tip here, never, ever sweep this into an other bucket and just hope nobody asks. It is a massive red flag. Section 3, the double count trap. The really crucial part is knowing how all these pieces fit together. Let's look at the most common accounting trap in the industry, using our Chapter 9 teaching quantity of 1 million RINs. Imagine your desk reports a profit of $1,501,700. Sounds like a phenomenal result, right? But let's look at how that was constructed. Let's say our physical route has a modeled make cost of about 80 cents per RIN, totaling $798,300 to generate that million RINs. If the market buy alternative is a $1.20 base, that's $1.2 million. So our physical route advantage is $401,700. Now assume the physical desk transfers those 1 million generated RINs to the credit desk at that $1.20 market price. Then the market drops to $1.10, causing a credit mark-to-market loss of $100,000. And this right here brilliantly illustrates the double count trap. The wrong math takes the physical benefit of $401,700, adds the internal transfer value of $1.2 million, and subtracts the $100,000 market loss, giving you that massive $1.5 million profit. It looks like accounting magic, but that internal transfer is just allocating accountability between books. It does not create new group value. The correct math takes your physical advantage of $401,700, subtracts the external mark-to-market loss of $100,000, and leaves you with a group-modeled result of $301,700. The internal transfer has to eliminate entirely. Honestly, this is one of the most reusable controls you're going to learn in this entire program. Section 4, Status, Exposure, and Invalidation. Let's talk about the absolute biggest jump scare in biofuels trading: status exposure and retroactive invalidation. Status exposure is your economic or compliance sensitivity to a life cycle state change rather than just a market price movement. You have to remember this. A credit generated, sold, settled, and even surrendered can be voided long after the fact. And when that happens, the obligation returns, not just the money. Listen closely here. We have to treat this validity exposure as a first-order risk that sets the price, rather than just some scenario overlay sitting on the side.
Just look at this timeline. A credit is generated on day 1. It transfers internally on day 5. By day 30, it's happily marked active. But then, fast forward to day 120, an evidence failure or lineage exception surfaces and it is retroactively quarantined. The compliance gate just slammed shut. Let's put a real number on that jump scare. The market price hasn't moved a single cent. It's still $1.20. But because those 1 million RINs went from active to quarantined, your hard compliance coverage just dropped by 1 million units. You now have to buy replacement credits under stress. At our current course stress replacement cost of $1.50 per RIN, that's a $1.5 million financial hit. It is literally a career-altering event. And the most important economic event occurred without a single price move. That is exactly why status belongs firmly inside the senior P&L review.
Section 5. Obligated versus credit desks. Now let's look at these economic results through our primary dual lens. The obligated party holds a position because a blending mandate runs against its physical fuel. They are protecting a mandatory endpoint. Their main downside is a physical shortfall and a restored obligation. On the flip side, a credit-only trader has absolutely no reference obligation. They hold a position because of a view on the credit price, optimizing elective, risk-adjusted returns. Because of this, the exact same market event will frequently push these two desks in completely opposite directions. You can standardize your inputs and controls, sure, but do not force both desks to optimize the exact same aggregate P&L number.
And finally, Section 6, the senior dashboard.
So how do we actually bring all of this together to steer the ship? We build the non-negotiable management view. The core maxim here is that P&L, compliance state, and cash absolutely must belong on the exact same management page. A positive P&L number by itself is insufficient. Your dashboard has to show the P&L bridge, it must visibly eliminate internal transfers, and it needs to treat unexplained P&L as an urgent control signal, which, by the way, often points to a missing state transition. It has to put gross cash requirements right next to P&L, because a highly profitable desk can still consume massive liquidity. And crucially, it must show hard compliance coverage and quarantined inventory right next to that cash.
A profitable biofuels book is not necessarily a healthy biofuels desk. You now have the discipline to reconcile the result to the molecule, the hedge, the regulatory instrument, cash, and status. But knowing how to read the numbers is really only half the battle. You know how to read the P&L now, but do you know how it usually falls apart? That brings us perfectly to the close of Module 1. Next time, we're diving into Chapter 10, Lessons from Failed Biofuel Books, where we compress everything we've learned into recurring desk failure patterns and permanent operating habits. You definitely won't want to miss it.
Hello, everyone, and as a consultant with Durga Analytics, I am absolutely thrilled to welcome you to this explainer. Today, we are officially wrapping up Module 1 with Chapter 10 of our master program. We're going to be looking at something that is honestly fascinating: the autopsy of a failed biofuel book. Now, if you spent any time designing ETRM systems, running compliance books against statutory blending mandates, or managing speculative credit books, you already know that this market is uniquely unforgiving. So let's dive right in and uncover what actually breaks a desk. Today's explainer is going to cover these 6 areas: course map and context, the anatomy of a failed book, the arithmetic of risk, obligated versus credit-only desks, the 5 desk gates, and finally, institutionalizing desk habits. Okay, Section 1, Course Map and Context. Just to ground us in where we are, this program is a sequenced journey across 8 modules and 110 chapters. We've already moved past our primer annex, those foundational modules 0.1 through 0.14, which sit before Chapter 1 and are not counted in the 110. Right now, we're closing out Module 1, defining exactly what a biofuels desk is accountable for, before we hit the brutal realities of market structure in Module 2. To start, we really have to discard this Hollywood myth of the rogue trader wildly swinging for the fences. I mean, as fun as it is to blame the guy sitting behind the corner monitor on a biofuels desk, massive failures don't usually start with wild recklessness. Honestly, the road to a blown-up book is paved with entirely reasonable, everyday decisions that just compounded in the wrong direction. Moving to Section 2, Anatomy of a Failed Book. Let's break down exactly how these failures accumulate, step by step, right there on the desk. So here is how that chain of failure actually builds. It always starts innocently enough. A modeled mark looks favorable. But then, a trader makes a guess on regulatory scope, and they accept compliance evidence a bit too early, locking into an irreversible volume commitment. By the time market conditions shift and the real truth of the compliance status is revealed, it's too late. You're already staring down a massive shortfall. And because of that, you will so often hear a doomed trader say, "But the registry was clean." Listen, this is literally the most dangerous phrase you can hear in a post-loss review. A clean status on a registry only proves that a transaction occurred. It absolutely does not guarantee that the seller's lineage, the feedstock pathway, or the QAP status is actually going to survive a regulatory audit. Section 3, the arithmetic of risk. Let's make this totally tangible and run some actual numbers on a 50 million RN reference obligation. Just imagine a constructed 3% exposure movement on that 50 million RIN obligation. Well, that suddenly creates a 1.5 million RIN problem on your desk. Now, 3% might sound totally manageable in percentage terms, but percentages don't cover shortfalls. Now let's look at how the financial reality completely balloons. At a base modeled mark of 84 cents, you're looking at a headline consequence of $1.26 million. But any seasoned desk head knows that 84 cents isn't the real number, right? Once you properly account for the sheer size of the reserve, the actual cost of verifying evidence, and a stress replacement scenario at $1.15, that $1.26 million headline inflates to $1.725 million. The decision threshold on a desk is never just the headline price. It is always the executable economics of replacing that exact volume under stress. Section 4, obligated versus credit-only desks. This is absolutely crucial because the purpose of your book completely changes your control framework. We really need to split the lens here. If you're a credit-only trader holding a speculative position, a 1.5 million RIN problem is painful, sure, but it's elective. You can just exit the position, take your lumps on the drawdown, and move on. But if you are the obligated party, holding that position because a statutory blending mandate runs against your physical fuel, you are trapped by a ticking compliance clock. You can't just walk away. You face a hard, mandatory shortfall that absolutely must be filled. Which brings us to the ultimate nightmare for the obligated desk, retroactive invalidation. We call this the zombie obligation. A credit that was generated, settled, and even officially surrendered can be voided by regulators long after the fact. And when that happens, the obligation resurrects. It comes back from the dead. You have to treat validity exposure as a first-order risk, not just some theoretical scenario overlay. When retroactive invalidation hits, the obligation itself returns, not merely the money. Section 5. The 5 desk gates. Now that we've thoroughly diagnosed the illness, let's look at the cure. Before taking the next irreversible action, a desk head has to pass every single transaction through these 5 gates. You must ensure the exact scheme scope is defined. You must have verified evidence of the intended use. You need executable economics, not just a screen price. You must have the liquidity to actually fund and exit. And finally, you need named, time-stamped authority. If a trader cannot answer these 5 questions, they simply shouldn't be permitted to hide that gap behind a precise market price. So, applying the scope gate means recognizing that scheme identity survives every single abstraction. Blending U.S. mechanics, like decodes and seller lineage, with EU requirements, like member state applicability, is a fast track to a failed book. If your ETRM system treats an RFS RIN and a RED 3 certificate as the exact same generic green credit just because the economics match, your system is literally waiting to collapse. All right, Section 6, institutionalizing desk habits. To properly close out Module 1, we have to translate these lessons into operational discipline.
These 6 artifacts must live continuously on the senior desk. P&L is a bridge. It's not just a score. A profitable trading book can absolutely coexist with a worsening hard compliance shortfall. So these artifacts ensure that your paper hedges, your physical fuel constraints, your credit P&L, and your hard compliance coverage are always reconciled on the exact same senior page. This is exactly how you stop problems while they are still small, reversible, and most importantly, cheap.
So we've built the control framework and we've defined our desk habits. But what happens when we unleash these theories into the brutal reality of the open market? In Module 2, Chapter 11, we are going to confront real, unforgiving RFS risk. The question is, can your book survive a volatile instrument life cycle? Thank you so much for joining me in this explainer, and I will see you in the trenches for the next chapter.